Central banks around the world share one primary mandate: price stability, and universally they define that stability as a rigid 2% annual inflation rate. Despite its role in guiding interest rates and corporate planning globally, this specific number was not derived from a complex economic model. In 1988, New Zealand was dawdling high inflation. During a television interview, the nation's finance minister was pressed on a preferred level and suggested, off the cuff, that he wanted to see a rate between 0 and 1%. The Reserve Bank of New Zealand felt they had to work out a specific target following that interview. They estimated an upward bias in inflation calculations of about 0.75%, rounded it to 1%, and created a target boundary of 2%. The mathematical rule that now governs global monetary policy began as a casual media remark, rather than a scientific discovery. This target spread quickly across the globe, eventually being officially adopted by the U.S. Federal Reserve in January 2012, under the leadership of Chair Ben Bernanke. The decision to formalize this number was built on a theory called anchoring. The logic is that if an institution publicly commits to a 2% target, businesses will set prices and workers will negotiate wages based on that specific expectation. Locked-in expectations help moderate long-term interest rates, which theoretically gives the Fed more room to act when the economy faces a significant shock. This 2% target operates as a psychological tool designed to control human economic behavior by setting rigid expectations. This chart shows the 2% target threshold. Recently, economic pressures caused inflation data to violently breach that boundary. Within that breach, a gap opened between the two main measures, the Consumer Price Index, CPI, and the Personal Consumption Expenditures Index, PCE. The Federal Reserve prefers the PCE metric, which tends to move slower and report lower numbers. However, consumers feel the higher CPI numbers more acutely, because that index places a much heavier weight on the rising costs of housing and shelter. This creates a situation where institutions can claim success using one metric, while the average citizen experiences a much more painful financial reality measured by the other. For Americans aged 25 to 45, this data gap translates to a daily struggle. Over half of the population now reports that price increases have caused significant hardship for their families. Data from the University of Michigan shows consumer sentiment reaching record lows, driven by a perception that the cost of living has become the primary obstacle to financial well-being. When the public stops believing the 2% target is a reality, the anchor breaks and people begin to change how they spend their money. If a household expects 4% inflation next year, they will front-load purchases of durable goods today to beat the next price hikes. This sudden surge in consumer demand creates more pressure on prices, effectively fueling the very inflation that central banks are trying to slow down. When the public loses faith in the anchor, their adaptive behavior reinforces the inflationary cycle. While the Federal Reserve maintains its rigid institutional stance, the gap between official targets and consumer expectations has reached a critical point. When institutional promises and lived reality diverge, individuals often look for ways to actively protect their own wealth from persistent price increases. One specific tool used for this purpose is Treasury Inflation Protected Securities, or TIPS. Unlike a standard bond, which loses value as inflation rises, a TIPS principal value is directly indexed to the Consumer Price Index. If the CPI goes up, the TIPS principal rises with it, ensuring the investment keeps pace with the actual cost of living. Using these assets reflects a transition from relying on an institutional psychological anchor to hedging against its potential failure. Central bankers will continue to debate target metrics from within their isolated headquarters, but the true value of money is ultimately dictated by human psychology and the collective behavior of consumers. When a target anchor is no longer enough to hold expectations, protecting a portfolio requires betting on human behavior rather than institutional promises.